Welcome back everyone. In today's episode, I'll be covering the stocks that are in free fall after earnings. So for reference, this is my portfolio. I own a lot of different stocks here. I won't be covering any of these ones today. I'll be covering the first stock that has dropped massively, which is Fortinet. So Fortinet reported its earnings. It's a cybersecurity company. And after reporting its earnings, the stock is actually down around 25%. So the company now is trading at a 29 times earnings. And if you're to compare the valuation of Fortinet as compared to all your different other software cybersecurity companies, Fortinet is actually trading at a massive discount as compared to all those different cybersecurity companies. So why is Fortinet so cheap relative to all its competitors? It's because Fortinet has around 30% of its revenues coming in from the hardware segment. So for Fortinet, these were their earnings. So the revenue was up 14% year on year, which was a beat. Their adjusted earnings also came in at 64 cents as compared to the 59-cent estimate. And what went wrong with Fortinet was actually the revision of their guidance downwards. So they revised their guidance downwards from 6.675 billion to 6.825 billion of revenue, down from its prior midpoint estimate. And this is because the company is a bit slow when it comes to its firewall revision. So for Fortinet, if you're to look at the earnings of the company, this company has incredible fundamentals as well. And in the cybersecurity space, I think this is probably one of the better companies out there in terms of the valuation and in terms of the earnings as well. So if you're familiar with this space, I think this company could look interesting today after the 25% drop. So for Fortinet, the stock drop is probably an overreaction. This is a high quality business with fundamentals that are extremely strong as well. And for all your different cybersecurity companies, they are evergreen and businesses will have to keep paying for them. So for example, I know someone that owns a business and has been saying that although he doesn't like all these different cybersecurity companies, he will still end up paying for them every single month. And he actually bought Fortinet when it was at around $50 and he sold it at around $100 a share. So for cybersecurity companies, they are extremely sticky in the long run, and all your businesses will eventually have to use them in some way, shape or form, and they're evergreen as well. And so for Fortinet, this could be an opportunity if you're familiar with the space. The next stock that I'll be covering is Airbnb. So Airbnb is down around 10% today. It is currently trading at a 29 times earnings. So for Airbnb, the company reported $1.03 of earnings per share, which was up 99% from a year ago. That beats the 94 cents that was expected. The sales also increased 13% to 3.1 billion compared to analyst estimates of $3.03 billion. So they actually beat their earnings as well as the revenue, but the stock is down because the company is investing more money into its everything app. So the firm cautioned that the expansion will weigh on margins. So Airbnb is planning to spend $200 million towards the new business this year and doesn't expect a meaningful revenue from efforts in the near term. We believe the opportunity is significant and we are building for a multi-year view. So Airbnb's story is as such, the company is trying to turn Airbnb's app into an everything app with everything included in the app itself. So they want experiences inside, they want food inside. So besides your normal Airbnb and your normal home hosting app, the company is also trying to include all these different segments into the app itself to further strengthen the reinforcing loop for Airbnb. The CEO has a track record of performing well when it comes to all these different innovations. So if you believe in a story, then Airbnb could be a worthy investment. But for me, I think Airbnb is a company that is moving into new investments and the market hates the new investments right now because it won't yield them any tangible returns over the near term. The moat and the first mover advantage makes it a higher quality business as compared to Booking. But of course, Booking is probably the better investment because Booking has a lot more sound capital allocation. The company just buys back a lot of shares, returns cash to its shareholders, and it is a lot more shareholder friendly as compared to Airbnb. So for Airbnb, I'll be avoiding this one. I think Booking is a much better investment as compared to Airbnb, although Airbnb is the higher quality business in the same space. The next stock that I'll be covering as well is Eli Lily. The stock is down 15% today and it is trading at a 52 times earnings. So why exactly is the stock down? The stock is down because they lowered their expectation of the oral weight loss drug that they're having. So they actually reported that the average weight loss was around 12% as compared to Novo Nordisk one, which was at around 17%. So both drugs are currently in phase 3 already, but for Eli Lilly's drug, it is seemingly a lot less effective as compared to Novo Nordisk drug. So for your pharmaceutical companies, they're typically avoids because they're extremely unpredictable. I mean, one news like this could change the entire story of the company. Pharmaceutical companies are generally gambles unless you really know the space. So for me, I think Novo Nordisk as well as Eli Lilly, they are avoids in this space. Novo Nordisk is prone to Trump's actions as well, which could come into effect soon. So for me, I'll be avoiding all these pharmaceutical companies, and this includes Eli Lilly as well. The next stock that I'll be covering is Crocs. So Crocs is down 27% today. It is currently trading at 4 times of earnings. I mean, this company is just extremely cheap right now. So for Crocs, they actually beat their earnings. So earnings actually came in at $4.23, surpassing estimates of $4 and improving from $4.01 in the same quarter last year. The revenue also rose 3.4% year on year to 1.15 billion, slightly ahead of analyst estimates of 1.14 billion. But despite all this, the stock is down because they lowered their revenue guidance. So the company is projecting between 9 and 11% decline next quarter, and this was what spooked investors. So for Crocs, it is currently trading at 4 times of earnings. I think the company should just do a special dividend and give it back to its shareholders or pay down their debt. The company is doing buybacks right now, but for companies with weakening underlying businesses, buybacks may not be the best idea. So for Crocs, it is another example of a company that has a weakening business that is just doing buybacks, and that is typically not a very good stock that you want to hold on to. Next portion, I'll be covering some stocks that I'll be planning to add into my portfolio. So this is my portfolio for reference. And the first stock that I'll be covering is Visa. So Visa is a company that is almost bulletproof. Visa and MasterCard are payment rails that won't be going anywhere anytime soon. The company is down because of weak retail reports by other companies, as well as some talks in the South American countries that they'll be developing their own payment networks in their own countries. So for Visa, if you have to do a reverse DCF calculation for the company is pricing in around an 11% free cash flow growth over the next 10 years. So historically, over the past 10 years, Visa has actually grown its free cash flow by around 16%. And so at 11% today, I view the company as around fair value. I think Visa trading at $330 a share today is currently around fair value. So I'll be hoping for this one to drop a bit more so that I can add to my position soon. Visa is one of the highest quality businesses in the entire world, and a stock like this coming down so much is typically a good buying opportunity. The next stock that I'll be covering as well is Fair Isaac. So FICO is one of the strongest companies in the entire world with strong network effects and high switching costs as well. So your FICO score is deeply embedded into all the different lending decisions that all your different banks and your mortgage lenders make. FICO is the standard for consumer credit debt, and the value the company's score brings far outweighs the cost of the actual score. Scrutiny like this will typically die away as time goes by, and so for FICO, the poor sentiments today will eventually switch over time because the company has an extremely strong underlying business. So for FICO, if you have to look at the valuation itself, I mean the valuation is still relatively high. It is still at around a 50 times earnings, but on a historical basis, this is around a median point of FICO's PE ratio. It's quite remarkable how Dev Cantasaria didn't sell the company when it was at 100 times earnings back a few months ago. And Dev probably thinks that this company is one of the highest quality ones out there for him to hold this through 100 times earnings just a few months ago. Last portion, I'll be covering some questions left in the comments. So the first one, it says, hey, could you look into the healthcare industry right now? Specifically Novo Nordisk, I appreciate your thoughts. So Novo Nordisk is trading at around a 12 times to 13 times earnings today. For Novo Nordisk, my problem with the company are as follows. So first thing, you have your Trump and your most favorable pharmaceutical country in the entire world. I mean, if that comes into implementation, then your drug prices in the US will be depressed, which will drive down margins for Novo Nordisk. And besides that, the entire pipeline of the company is just on weight loss drug. And the company's patents are about to expire in 2031. So you're basically buying a call option that will expire in 2031 if you believe in the company. So for me, it is an avoid today. The next question, it says, just curious, may I know why you don't own Palantir as well as Nvidia, the trending stocks? Any reason behind it? So for Palantir, it's simple. The valuation is extremely high for this one. The company is trading at a 300 times forward earnings. What they're doing is incredible, but the business is complex. 90% of the retail investors that own Palantir don't understand the business. And for Palantir, it is simply too expensive for me to even consider buying into the company. As for Nvidia, I view ASML as the higher quality, more predictable business. Nvidia has sky-high margins right now, and the margins will eventually come down over time as AI becomes more commoditized. That's my view on Nvidia. Hopefully you guys have found this one useful and invest safe.